Hey guys, thanks for tuning back in for another episode. I'm Branden Ducharme out here in St. George, Utah, joined today by actually one of our other hosts from the NAAIM organization. You can oftentimes find him hosting some of these NAAIM Confidential podcasts. We have Asher with us today, the owner of Magnifina, located out in New York City. He's in the hub, the actual hub itself, and gets to witness all the hustle and bustle thereof. So interested to have somewhat of a conversation, and hope you guys find what we have to talk about today interesting. We'll kick it off by just doing a quick market recap. Obviously, markets have been on a pretty good tear, volatility suppressing, and the sectors are moving and shaking quite a bit. Utilities, still some big moves happening there. Technology emerging today, in particular, value really outperforming. The name exposure index this week is at 86.64, which is slightly higher than the last quarter's average of 81.7. Asher, we've had a lot of conversation, not a lot, but we've definitely had some conversation in the past about the name exposure index. And I know it's something that you've looked at a little bit more than me, interestingly enough, using it as a way to, I kind of understand you look at it almost as like a potential like momentum factor or like a magnitude and change and what that sort of can indicate. Refresh me.
Yeah. So, well, thanks for having me today. And right now 80 is kind of nothing to write home about. That's like hold for me. But what I look out for are big swings. So July of last year, it swung down from like the 80 range down to I don't know, maybe take a look, like 40, just below 40, and a big swing very quickly kind of indicates to me like, okay, I better ease up and got some volatility ahead. And the market was a little iffy until like October or something like that. It started swinging the other way, and that was like a big bottom for the market. And it just rallied hard off of AI, everything from there. So the last almost a year, we've been kind of 80 plus minus 15, and that's to me that's just like steady as she goes.
Yeah. So I'm a very technicals heavy person as somebody that's in the CMT program. But you are not though. You take me back to my college days, talking about valuations and fundamentals on individual issues, right? And names, which is somewhat uncommon these days. I don't feel like there's a lot of kind of bespoke firms out there that are picking names according to an investor's wants, needs, desires, risk capacities, whatever it might be. It's so much now looking at the indexes or sectors or something like that. Tell me a little bit about how you went on your journey to decide that that's the way to be the most effective investor in your mind or through the lens of which you view the world.
Oh man, well, I'm not sure if it's much of a journey, but I started investing in stocks when I was like in high school. A very small college fund left to me by my grandmother, and that was right when internet brokerages were kind of opening up and commissions were coming down. So it kind of made sense that my father's suggestion that I try to put that college fund to work. And because of what no one was really talking about ETFs those days. I think SPY was trading, but it was watch CNBC or read the Wall Street Journal. Everyone's talking about individual stocks. So that's kind of how I grew up with the market, just picking individual stocks, and started off learning about PE ratios, and then got a little more and more sophisticated, looking at other different factors, and also thinking about the future. Valuation is oftentimes kind of backward looking, but stocks do move based on valuation, but also future growth potential as well as other factors.
Where did you start your career? So you had some experience trading stocks, your own stocks, as a teenager, high schooler. What'd you do from there?
Well, let's see, after college, I went to work at a currency brokerage. It's something about the idea of currency trading just seemed very cool and interesting and fast paced and like, I don't know, intellectually engaging, and I don't know, it's just mysterious and exciting, and it's all the cool things. It just seemed very cool. And then I kind of quickly learned out that it's pretty shallow, just there is no like following the headlines of international intrigue or anything like that. It's kind of just like economic news of the day and big flows from bank clients and stuff like that. But it was, kind of an excellent primer into technical analysis, because that's all there really is to it, in my opinion. Short-term currency trading. So I was trading for a brokerage here in New York right after college, and then I went to one of the top 10 banks and was on their forwards desk, and was a dealer of forwards. I prop traded spot, and my real mandate on the desk was to implement algorithms, kind of prop algorithms in spot to just to kind of boost the desk's profits. And most of them were like day-to-day trades, but there's some were extremely high frequency trades.
So some kind of swing trades or multi-day trades, sometimes a couple seconds, sounds like.
Yeah. I was really good at responding to news. So I built these algorithms, and when economic news gets released, market moves almost instantly. And one of my strategies capitalized on that.
Okay, that's interesting. So you started with individual issue, and then you got a job trading currencies of all things, which is interesting because if you kind of started by picking off individual issues, right? And I would say, knowing you probably did that kind of on valuation and future forecasts that way. In currencies, you can't really do that. There's not a production component to currency. Right?
Yeah, exactly.
It's like the opposite end of the spectrum, right? From fundamental valuation. And so you start fundamental valuation stocks, you got technical analysis and algorithmic trading with currencies and pairs and forwards. That's a world of different. You ever have a moment where you were like, this, for some reason, this is crazy. I don't know why I'm doing this, and I think I can do better picking individual names, right?
Absolutely. So, well, I wasn't always a valuation guy. I kind of began trading or investing stocks during the internet bubble, so valuations went out the door pretty quickly. But yeah, I was on the desk trading currencies, just kind of looking down the desk, and there was a guy literally counting the days to his retirement. I just thought, we're doing the same thing. He's been doing it for 40 years longer than I have. There's like kind of no growth or no change in the job. It's just the same thing every day. Just try and beat the market every single day. And I just kind of said, what am I doing here? Didn't know that I was going to go back into stocks. So it was during the financial crisis. I just said, I'm just going to go back and get a master's and figure it out. And then kind of just lucked into finding some clients with a sudden money situation from a tech exit, and it kind of became the core of my business.
Okay. What'd you get your master's in?
Economics.
Master's in economics. How did that play a role in the way in which you do valuation at all, and how you kind of did that help form your thesis?
No, not at all. So I loved economics undergrad because it was kind of like learning about this, learning about the fiscal economy, the monetary economy, international economy. It's learning all this theory and stuff like that. Postgrad, it was all just math and models and abstract stuff that was not really useful. It's kind of like if you wanted to be like an academic economist at a central bank, modeling something, blah blah blah. And what it did teach me is how to just not to be scared of math, not to be like intimidated by statistics and statistical algebra and stuff like that. So it helped me learn just a number of different mathematical techniques, which have been useful in testing ideas and whatnot.
Okay. So you get this master's degree that doesn't really necessarily apply to what you're doing, but you got it. That's cool. I'm still curious, like how you landed on like the valuation component. Hey, I think I can produce alpha in some kind of risk adjusted capacity by picking individual names based upon valuation. It's a really hard thing to do, right? So I want to hear more about the story.
Why did I? Yeah, okay. I guess maybe I just never learned like that the state of the market had gone towards like a passive index route or anything like that. And the funny thing is, even with all the technical analysis I learned in currency trading, I never thought to apply it to stocks because with currencies it's always double-sided. You buy one currency, sell another, and with stocks there's kind of like a natural growth trend, like a progression, and the numbers always get bigger. So I just thought, oh, you can't really do technical analysis that way because because I learned in currencies where it's symmetrical. Either side, it could apply to the buy side or the sell side. And stocks, I just didn't really think you could use it shorting stock. So I just kind of thought, well, all there is good old fashioned fundamental analysis, looking at the financials, looking at ratios, trying to find a growing company. And so yeah, I just didn't learn another way. I didn't think it was a better way. It was all I knew.
Okay. Well, it certainly seems to be working out for you. What's the process like when you do your valuations? You're working towards picking, individual names, and particularly like in a market like now. I mean, it's just, the momentum in the market the last couple of years been so crazy. But what's interesting is under the hood, it narrows out, it narrows and then widens out, and narrows and widens out, which I think it kind of always does, right? But as you go through different cycles, how do you have your process of your fundamental valuations and analysis to cut out the noise of all of that and just get to what it is that you need to buy?
Right. So the first thing is I don't try to do like the full discount cash flow, find a fair value number or anything like that. I think that's a lot of work for something that's not necessarily gonna pan out. I just look at for relative valuation. So, what stocks are, for example, the lowest 10% of the PE ratio for that industry or something. You have to be careful there because a lot of stocks have a low PE ratio because they've just come down and, they've just got hit hard because of bad news or something like that. So you got to filter those out. And
why would you not? So if a company just had bad news come out, their share price came down, and so now their PE ratio is looking good because the share price just came down, but earnings hadn't hit. Why would that be why would that be a value trap? Why would you not want to buy that, right? If you were saying like, hey, I want to buy value, isn't that when it's discounted?
It depends. The market's pretty efficient. So if the price comes down, it's because there's some serious long-term bad news, questionable accounting or, loss of a major client or change in legislation. But a lot of times you can find great value, in distressed equities. One of my favorite investments was a company that provides mortgage insurance. This was a few years after the financial crisis. So just in like the timeline of things, they're sort of the last ones to recover. They feel the pain last out of everyone from the subprime bubble. So they began recovering, and they were dirt cheap. And I'm just thinking like, well, we're going to go back to normal, and normal is people need to get mortgage insurance. So it's the most boring company. It has nothing to do with AI or tech or internet or anything like that. It's mortgage insurance.
Much more boring than that.
Talk to someone at a cocktail party about mortgage insurance, right? But it was a great investment. It did like a 5x in a couple of years.
Wow. That's so that's the relative valuation. So when you're saying relative valuation, did you find that because it was looking cheaper compared to a peer group, or it was cheaper compared to the broader market?
That was a bit of a special situation. That's just kind of, I don't even remember how I found it. Just reading some article in the paper and looking up the stock behind it and just thinking, you can't rely on those. Those don't come every day. And I feel like there are more of those in the 2010s than in the last 5 years, for example. Everything's been some momentum based now, but there were special situations.
You think that has to do with like the information flow at all? I think back to the 2010s. I was finishing up high school. I didn't have an iPhone. I didn't, I wouldn't have fathomed getting the news on my phone when I was, in high school at that time, right? And I think back even to my early days in kind of my first pass I had at college, right out of high school, and I wouldn't have thought that way either. And so has the information flow changed the game on valuation, where it's harder to find relative valuation? The market's become more efficient, or it would at least appear so. I don't, whether it's efficient because it's truly efficient, or it's efficient because everyone just buys stuff through, index funds and sector funds that kind of just captures all the beta together. I think that's a deeper, maybe different conversation, but has the information flow really changed valuation and how that has to be approached?
Maybe, but not quite in that way. So, I think that the last 5 years are really defined by passive investing bubbles. People pile into the same ETFs. Those ETFs have to buy things in whatever proportion they're allocated to, and that exacerbates momentum. But also just the idea of something going viral. Before, more than 5 years ago, I don't think a viral news story or whatever bouncing around social media would have attracted so many investors. There's kind of a new generation, the social media generation of investors now, and some story goes, bouncing around Facebook, Twitter, everywhere, and it creates a lot of buyers. These days, I am finding, I'm finding great value and growth in, boring old companies that you won't go viral, like a company that makes HVACs or like electrical components. So I think they're still out there, but what's really been moving, market indexes and big momentum names is just, the herd mentality, people following along. I find a lot of opportunities in the small and mid cap range, and something Peter Lynch points out in his book, which is kind of a guidepost for me. You got these big pension funds and asset managers and even ETFs, and they can only, their universe of stocks is like, I don't know, 700-800 stocks, but there's another like 3,000 that are just too small for them, that are still have companies that can grow 25% a year, which is, if you fill a portfolio up with those and there aren't any landmines, it's a pretty good return.
Build up a portfolio with those, and I suppose you could afford to have a couple landmines. That would be the hope, I suppose. How do you determine an exit point, right? So, Warren Buffett always says, I can't remember if it was Warren Buffett or Charlie Munger. They said like the ideal holding period is forever, right? And although it's a nice sentiment or a nice idea, realistically, it's just not feasible for most people. And I think it's not feasible for most companies, right? I think especially if you're a growth focused investor, there comes a point where you may want to de-risk for whatever reason, right? There's maybe a ton of them. How do you determine an exit point when you're doing fundamental evaluation? Are you looking for that long-term hold that just says, yeah, we're looking for that compound growth rate over the next 25 years? Or are you taking more of the approach to say, hey, this is just so significantly overbought relative to what we think the valuation should be? We're taking an exit point here.
So, yeah, it would depend on the client, depend on the portfolio. There are probably a lot of clients where the only exit would be like if I change my cash target because of a change in my because we're active managers and we do that. So it might just be time to raise cash, just cut my least favorite ideas out. But otherwise, for more aggressive accounts, the ideal thing, and it doesn't always work out this way, but is to try to have 20 to 30 really great ideas, and when you find a new one, you kind of bump out the least favorite idea from the existing ones.
If I'm understanding you right, like from a fundamental standpoint, if you somehow got wildly lucky and every idea is a winner, you're okay to let your winners run, not saying, hey, even if a month later we 5x, like we're just going to keep letting it run until we find something that we like even more, and that's when we'll take out the least favorable idea we have and make an allocation to this new idea. But it's got to be a better idea than what we currently have.
Right, but that doesn't give every good stock a pass. So we happened to have like a 50% overlap with the Cathie Woods portfolio during COVID, high, growth stocks, and they ran up and got super overvalued. Then maybe they're too much too far. Maybe valuations come down. We did kind of decide, let's take some profit on this and here or there. I felt like it's an active decision. I don't like the prospects for this company over the next little bit. Maybe it's going to be good in 10 years, but it's not going to be good the next, I don't know, 2 or 3. So even companies we love, we are constantly reviewing them.
So it's an interesting balancing act. Because ideally, if a stock sucks for 8 years, but in years 9 and 10, it makes all the gain, sometimes you have to, people would say, well, you have to ride that ride, right? And so it doesn't matter what the prospects of the stock is in the next 2 to 3 years. That's just irrelevant because you're paying attention to what it's going to do in 10, right? And either whether it's, different investors or different clients are saying, well, I do very much care what happens over the next 2 to 3 years, regardless of where we really believe it might be in 10 years. That's just not the time frame on which people seem to really be able to allocate and focus their attention. So how do you balance that type of decision when you're doing fundamental valuation, especially if you're looking for deep value that's, more projected out into the future.
Well, I think the market can ignore a good idea for maybe 1 or 2 years, but they couldn't ignore it for 8 or 9. So I wouldn't have like a 10-year target. I usually have like a 3 to 5 year target.
Okay. That's interesting. I think like the textbook around asset allocation would say if it's less than 5 years, you ought to just allocate to bonds and buy bonds rather than equities. And I'm not recommending anyone, do any which way. It's what's interesting is that what I'm kind of hearing from you, and so correct me if I'm wrong, is that hey, if you have a solid fundamental valuation process, there might be a way if you have a 3 or 5 year idea max, then that is the time frame that you could potentially pick up an idea in talking about single issues and stuff, right? So
exactly. So if your entire investing horizon is 5 years, yeah, you buy bonds, but potentially, but my clients' investing horizon is longer than 3 to 5 years, but we're only looking, I'm only looking at the next 3 to 5 years for any individual stock. So the decision is, we're going to be in stocks for longer than 5 years, but
sure.
only evaluating each individual idea over the next 3 to 5. I think it's almost like a sweet spot. Like if you're trying to look quarter to quarter, you're gonna get confused by noise with whatever the market's doing, and beta, all that stuff. And you try to look further out, there's just a zillion different things that could happen. But 3 to 5 might be kind of an interesting time frame to find patterns.
Yeah. Well, as we run out of time here today, hit me with your best investment quote, Asher. Let's get some insight into the wisdom of Asher and how he views the world of investing through a singular quote of another human being.
Oh boy, I think just about anything Peter Lynch has said would qualify. As a host, I knew I was going to have to do this, but I forgot to prepare something.
Well, that's funny. It's like I should have guessed it was going to be like a Peter Lynch thing. That seems par for the course.
I'll give 2 concepts from Peter Lynch that I love. And the first one is that he says, if I find 10 stocks I like and 2 I love, I have to buy all 10 because it's always a different 2 that turn out to do the best.
Okay.
It's something like that. That's just paraphrase. And then
the
other thing he says is he's like, I look for businesses that jobs no one wants to do, just dirty work, garbage removal, pollution cleanup, funerals, like just dirty work that's unglamorous. That he's just like, I find great businesses there, great stocks there. That's the stuff everybody needs. Nobody wants to do, and they just tend to perform well. He wrote that in his book from like 2001, but it's just been so true over the last like 25 years. Like one of the greatest stocks is called over the last few years is Cintas, and they make uniforms for like janitors and I don't know, restaurant workers, and just uniform. They just make uniforms, and it's nothing you're gonna see on CNBC, but you look at the returns on that, you'd be amazed. And waste management,
Sure.
Yeah, I think that's a famous example of just a consistently outperforming stock.
Famous example of some good golf.
From what?
Some good golf. The Waste Management Open. You don't know about the Waste Management Open?
No, I don't.
Oh, you New Yorkers! All right, we'll have to have you out west for the Waste Management Open. It's a really big golf tournament.
For me this year, the highlight was I don't even remember the sponsor. It was I think some cognac sponsored a sail race here in Upper Bay. So.
Okay. Yep, lost me on that one. So, anyways, well, hey, I appreciate you imparting the wisdom of Peter Lynch on us today, Asher. Yeah. It's always the NAAIM organization. A lot of guys in there are pretty heavy on technicals, so it's always fun to have you around, being a fundamentals guy. You're very it's very outside of what I normally do, even though that's what I sort of learned in school myself. And it's just fun to always have these different viewpoints on something, and we're all trying to get to the same end destination, but we're taking some different roads to get there. And so we all have our own journey, but it's fun to collaborate and hear about other people's journeys too.
Absolutely. I mean, that's what I love about the organization. There's so many different ideas, so many different market timing, sector rotation, individual stocks from a technical perspective, fundamental analysis. It's just all these ideas, and this is just my approach to being active and trying to do better for my clients.
Yeah. Cool. Well, we're going to call it a wrap and hope everyone enjoys their weekend. And Asher, I hope to see you in Dallas next month. Maybe you going to be there?
Unfortunately not. My
Okay.
wife and I are expecting, so I don't want to go too
Congratulations.
far. Thanks. And feel like that's a good reason not to go. But if anybody else should be there, right?
That's a great reason. That's actually why I wasn't able to make it to the Uncommon Knowledge conference this last year. The same reason, but Outlook, I love Outlook, and it's just a great conference. So if anyone is on the edge of trying to get there or not, that's something that I've prioritized the last number of years in my practice, and it's made the world of a difference to me. The stuff I've learned, I've sharpened my skills as a professional, as a technician, and as a professional, I think I serve my clients actually at a much higher level because of the NAAIM organization. So anyone considering that, hop on the website. If you go to NAAIM.org, there's plenty of information on there. If you look at the events, Outlook, give you the dates, the place. It's down in Dallas. It's right at the airport. Fly in. You don't even need an Uber anywhere. You fly in, boom, right there. Grab you a hotel for 2 nights. Fly home, quick and easy. Totally worth it. So that being said, we'll talk soon, Asher.